today's speaker is special. And that is not because he's also a grandmaster in chess, or at least not primarily for that reason, but because very few like him have contributed to economic science, to economic policy making, and to the policy debate or the public debate across a wide variety of subjects at the very highest level like him. So it's my enormous pleasure today to welcome as our speaker Professor Ken Rogoff from Harvard University. Ken will talk about the topic of central bank independence, and perhaps many of us economists, and I do not exclude myself here, this is a topic that we haven't devoted enough attention to because we tend to take it for granted in our model writing and in our discussions. But it's not such an old phenomenon. I remember when I started my job at the Bank of England in the year 2000, it was only 3 years ago, I think, that the central bank, that Bank of England had become formally independent. So it tells you how old I am, of course. But it's also an important topic today because central bank independence faces a number of challenges that Ken will talk about. Ken's lecture will be chaired by Professor Daniel Cohen, the president of our governing council, and Daniel also kindly agreed to introduce Ken a little bit. I think you have known each other for a long time.
A little bit.
And then Juan Carluccio from the Banque de France will say, before Daniel starts, will say a couple of words. Then Daniel will have his introduction and Ken will give his lecture, which should last a little less than an hour perhaps, and then there'll be ample time for questions.
Thank you very much, and I don't have your oral speakers. It's just to say that, we are very, of course, glad and happy to have Professor Rogoff as part of this series. I mean, I think he, as Tobias said, he really exemplifies the type of debate that we want to support with this chair, like sound economic reasoning based on academic, seriously and rigorous academic research. So please check out our website for future events that we're going to continue. The bar is quite high, and we look forward to hearing your views on this topic, which is, of course, very important to us. Thank you very much.
So no, I won't say much about Ken. Everybody knows Ken. He's one of our leading economists in international macro. We've known each other for a long time. It's been always a pleasure for me to follow what Ken has been writing from the very beginning. Ken is not just a fantastic economist, but he's so much fun when you read between the lines. To read his work has always been, sort of controversial in the positive sense of the word. I remember the very early work on exchange rate with Missy, where basically Ken explained that there's not much that you can predict with the models that we have, better than saying, well, the exchange rate will remain where it is, a random walk hypothesis. I remember at the time when everybody was excited about cooperation, Ken produced a paper explaining that no, cooperation can be counterproductive. The work on debt and everybody external debt, where we intersected, I would say intellectually really, where Ken sort of demonstrated that there was no way to sustain a debt equilibrium that was not bound to be leading to default, and all this controversy about the buybacks. The buybacks were very fashionable, and Ken produced an extraordinary piece with his co-author of the time, Bureau, showing that buyback was a boondoggle at the time. And of course, all the work that we all know him for, work with Carmen Reinhardt and all this fantastic, handbook that he wrote with Osfeld. So it's filled, our memory, our collective memory as international macroeconomists is filled with all the work that Ken has produced. He's a dear friend. I'm very happy to have you here. It's all yours. Thank you so much.
Thank you very much, and thank you to the Paris School of Economics and the Banque de France for hosting me here. I can't say enough how great it is to be in person. I've not done much of this the last couple of years, would be an understatement, except in my classes. And so it's certainly, really a pleasure to look at people. It's much easier as a speaker when you can see people's eyes. I mean, they're often bored, but it's helpful to know that that's what's going on and, move on to another topic. What I want to talk about today is a topic which has indeed gone out of fashion, central bank independence, and which I think, as Tobias said, people have for a very long time taken for granted. And I'm going to argue that we're entering a new era where you absolutely cannot take it for granted. And I want to emphasize, I'm talking about the whole world. I'm not lasering in on the ECB. I'll talk about the ECB, but each country has its own framework for central banking that matters. Each country has its own each region, its own institutional and political problems. If the talk I'm giving, there's a paper that was my Mayakawa lecture at the Bank of Japan, actually just a couple weeks ago, that's published online, probably not on my website yet, but you can see it on the Bank of Japan's website for some background, and then I'll refer to some other writings. It's, I have some sort of really, I don't know how to describe them, policy writings in Project Syndicate, which you can also find, which touch on some of these issues that I'm going to talk about. But before I sort of launch into it, apologies for just saying a little bit about my own intellectual journey on this topic, where I feel like I'm coming to work on again. My first job was actually at the Federal Reserve in the United States in Washington. I didn't go straight to academics out of graduate school. And when I went, there were actually very few countries in the world that had independent central banks. You could talk about the Bundesbank, kind of the Federal Reserve. The Central Bank of Thailand claims to have been independent, forever. There are different measures of this. And one of my very first papers that at least I got published, it took me quite a while, was proposing the idea that central bank independence was a good thing, and giving a framework of why it would be a good thing, particularly for trying to maintain lower interest rates and more stable inflation. And I had a terrible time getting this published. It was rejected at several journals with kind of nasty notes along the lines of, why would you think that something like this would work? The idea of institutional solutions to game theoretic problems was something that was not very popular. Actually, Daniel's being modest, that my own work on debt very much builds on work he did, and also with Jeffrey Sachs, where I think they kind of got it right, of really deep down emphasizing institutional issues on why countries repay their debts, the direct punishments that you impose. Whereas economists, they don't want to have institutions because they don't know how to model them. There's a very similar kind of thing. We could come back to that. Anyway, eventually I did get it published. And I think the literature took off from there. And obviously also that paper probably had quite a bit of policy influence. But where the way the literature evolved is my paper argued that it's very helpful to have an independent central bank, but there's a trade-off between commitment and flexibility. That was a central point of the 1985 paper, that if you had the central bank care about nothing but inflation, that was very good for maintaining low interest rates, but not very good when something bad happened, particularly a supply shock, something where there was just an inevitable trade-off. I'm going to come back to that point. The literature evolved. There was several further papers sort of trying to refine that idea of how to improve the trade-off. And then a very important paper by Carl Walsh, maybe 7 or 8 years after my paper, arguing that if you tuned the incentives of the central bank just right, you could kind of break that trade-off, and you just have the central bank eliminate any temptation to inflate and at the same time stabilize perfectly. Ben Bernanke wrote a book with some co-authors in the late 1990s. It was sort of empirical, but sort of taking off on this theme that inflation targeting could solve everything. And I think that for a long time, the literature sort of started to take the credibility of central banks for granted. And you focused on what Taylor rule should you have, what inflation targeting rule should you have. If we look at the academic literature, there actually has been a series of very nice papers by Marina Hollick and Pierre Yared on fiscal policy and monetary policy, which really brings back this trade-off between credibility and your ability and commitment. The trade-off between commitment and flexibility. I did not have private information in my model. They introduced private information, and not surprisingly, that restores the issue. There are many technical things around this. It's quite an interesting and lively literature. I think they have a 1922 Review of Economic Studies paper that's sort of the latest word on this. But it certainly, the idea that you could theoretically get rid of that trade-off probably was never right. It never made sense to me. Actually, what I argued, this is again an ancient paper, but not as ancient as the 1985 paper. I wrote a paper in 2003, which I gave at the Jackson Hole Symposium that maybe you've heard of, that sort of brings together all the central bankers of the world every August in a small Jackson Hole, Wyoming. And my paper was called Globalization and Global Disinflation. And what I argued in the paper, I presented a bunch of empirics about how inflation had come down, and I'll maybe come back to that later. Maybe some of you are so young you don't even know that there used to be a lot of inflation everywhere. If you went to 1992, there were more than 40 countries in the world with inflation over 40%. If you went to 2015, there are basically none. We have Argentina, Venezuela, but it's basically, feels like it's been almost stamped out. And what I argued in that paper, and I had a model, was that actually a number of factors, but particularly the rise of China, had just made it much easier to have low inflation and maintain decent growth. That was hence the title. It's actually it's not trivial to show that, because actually central banks have a lot of control over the inflation rate in the long run. And a lot of people, lay people, can't quite believe that. But how can you have high inflation and weak growth? So much of the young generation thinks whenever there's weak growth, you must have very, very low inflation. It must bring down inflation. You still see that comment today. And one of the reasons you can see that's a little silly is look at the different countries in the world. There are countries with terrible growth that have very high inflation, and you can look at many episodes where that's true, and it really depends on the underlying nature of the shock. There's been a very widely, my paper was basically rejected. They had to accept it. It was a conference volume. But the central bankers didn't want to hear about it. We're doing a great job. It's inflation targeting. It's central bank independence. We'll give you credit for central bank independence, but there's no trade-off. You're just wrong, and it's never going to happen again. We're never going to have a problem, and no one was terribly interested in the paper. In 2020, there's a wonderful book written by Goodhart and Pradhan that maybe you've seen. This has been everywhere, certainly in conferences and such, where they basically have the opposite theme, where of course we're in a period of deglobalization and inflation. And they make the point that demographics are changing radically, particularly in China. You can forecast pretty well what the labor force or the age distribution of the population is going to be in 2040, and it depends on retirement ages and such, but the widespread estimates are that the labor force in China is going to fall by about 200 million by 2040. That's just a staggering number to think about. And there are actually some other sectors. For example, Eastern Europe was a big, smaller but also important contributor to this rapid globalization. And as you well know, although Eastern Europe's and Central Europe are much younger than Western Europe, they're still getting old very, very fast. And so they make the argument that we're going to see this process in reverse, and that will create upward pressures on inflation. They have some other interesting ideas of saying there'll be a lot of super old people who basically aren't able to work and require very, very high levels of care, and that's also going to be a factor. But the globalization is a central point. They don't take up the issue which I did of why does that make inflation higher? Like, it makes it harder, but why does it make it higher? And I'm going to come back to that later in the talk. I think that's a central point. So there's an interesting debate going on. I have talked to central bankers in a number of countries in recent years making this point. I'll tell you, towards the end of my talk, reasons beyond the demographics that I think China's going to be China's interaction with the world is going to be very, very different over the next decade or two than it's been previously. But you tell central bankers this, and they go, we've solved this problem. No, it's not going to cause inflation. And I do feel there's been this lost notion of political economy that's going to come back, and I have to give tribute to my late colleague Alberto Alesina, who really, really pioneered this area. I'll mention one of his papers later on. And I do think issues of political economy are something coming back. So I'm going to, in a moment, launch into an interpretation of what happened in the United States, where inflation's very high again. But I just want to sort of paint the arc of what I'm going to talk about before I do that, of why I think there's been a change. So I think one factor is the young generation, and many people are not as enamored with the idea of central bank independence as the older generation. Maybe I'm now almost the Daniel and I are almost the very old generation, but there's certainly been a generational shift. You see that in lots of things. I'm going to show you a couple surveys. I only have a few slides, but I'm going to show you a couple surveys in a little bit. And this is part of a general trend towards, I think, if you polled the Harvard students, should we get rid of neoliberal institutions, you'd probably get 97% or 95% saying yes, not quite knowing what neoliberal institutions are, but clearly central banks are bad, that they're representing the rich and something that you should push back against. So they're certainly just less, and they've never seen inflation. They just don't know what it is. When I teach under both graduates and undergraduates, when I teach my undergraduates, even to some extent my graduate students, but particularly the undergraduates, they feel like I'm trying to teach them about Frank Sinatra or something, that it's just, your generation, it was actually my father's generation, listened to Frank Sinatra, but it's not relevant to us. It's never going to happen. We're never going to see it. And I don't think I'm exaggerating. I think that's just very deeply ingrained. And I hear people saying, now that we have the internet and online shopping and competition, you cannot have inflation anymore. And I'm going to show you some I'm going to show you the survey from the American Economic Association where you think they'd be more literate, which represents something pretty similar to that. So I think that's certainly, you know, been an issue. I'm going to talk about how the academic shift has changed, because I think that's had quite an influence in potentially undermining central bank independence. They take political economy for granted, and one issue I particularly want to pick up on, it's certainly relevant in the US but also in Europe, is there's this feeling not only don't we so much need central bank independence, we just don't so much need central banks. We don't need them to stabilize the economy anymore. Fiscal policy is better at that. We should use fiscal policy. And I think what a lot of people have in mind is they want a bigger government, and not exactly meaning that what we economists call stabilization. It's sometimes up, sometimes down, counter to the business cycle. And I think what a lot of people mean is up, government spending up when you have a recession, government spending stays up when you're out of the recession, and then it goes up more next time you have a recession. And I think that's how a lot of people think about it, and you can see that in the writings of some of the prominent left-leaning opinion writers who I won't name, who have that. The academics, and I'm going to come back to why I think this is just stupefyingly wrong and misguided. It's not that it's wrong if you have the ISLM curve. It's absolutely, I don't know, do you teach that anymore? I'm calling it that. You can shift government spending, you can shift monetary policy. They do the same thing. Well, they're not the same. The monetary policy has managed to be successful in being fairly technocratic. There's been a departure in recent years, I'll talk about it, but still fairly technocratic. Fiscal policy, you've got to be kidding me. I mean, if you, obviously when there's a financial crisis, when you have the pandemic, it's not very hard to get a consensus to move in the right direction. But in normal times, given the incredibly fractured societies that we live in, the idea that you can use fiscal policy like you know, brain surgery to do slight twists in the economy, the way in good times monetary policy's been able to do, that's impossible, because fiscal policy is not a single variable like the interest rates. It's tens of thousands of different expenditures, taxes. Who do we support? Do we raise taxes? Do we raise government spending? What is it that we're using as fiscal policy? And you can immediately see that it's very, very hard to make it technocratic. There have been efforts, and actually the Maastricht Treaty probably represents sort of almost the pinnacle of efforts to try to do that. And I'm not going to get into that here. It's very hard to do. It's not something that's really very easy to do. So there are a couple other things to mention. Certainly the zero bound on interest rates, which I had my 2016 book on the past, present, and future of money had a lot about this. I think that's played a major role in undermining central bank independence, because you know, if your main tool is the interest rate, and you can't really move the interest rate, or you know, move it only a little bit, then what are you doing? And I appreciate that the idea of quantitative easing was sold as what central banks can do, and I think that's just deeply misguided. That actually, and let's step away from the ECB, where quantitative easing is a completely different animal. It is by and large a subsidy from the north to the south. It's not a pure disinflationary policy. But looking in countries like Japan, the United States, Australia, countries with one government where that issue is taken off the table, quantitative easing, when it represents a government Federal Reserve or central bank purchases of government debt, is really, I argue in my book, and I'm not the only one, Mike Woodford's argued this too, are basically smoke and mirrors, because the government owns the central bank. and it's effectively just a shortening of the maturity structure of government debt. I'll come back to that issue. I don't want to dwell on it. Some of you, I often meet people who feel they've done research on quantitative easing and are convinced that it has a big effect. I think you'll find that that's faded a lot, the research in recent years. And it's also very colored by the quantity of research, the amount of research coming from central banks, which I think in this case are not neutral observers. They're trying to advertise that their instrument is great. There's a very nice paper called 50 Shades of QE. I don't know if you've seen this, where they basically point out that if you look at central bank research, finds quantitative easing is wonderful, and academic research much less so. So I think the zero bound's been an issue where central banks don't seem to be doing anything, and there's been pressure on central banks to try to cover in other ways, solve other problems. Since you're not doing anything, why don't you solve the environment? Why don't you create social justice? Why don't you solve inequality? The problems in many countries on this are really, the pressures are very, very strong. I agree with all those issues. It's just that the central bank doesn't particularly have the tools, it doesn't particularly have the competence to be a leader in this. It should certainly support whatever the Environmental Protection Agency is doing in the United States, whatever the European Union decides it's its environmental policy. The central bank should not run counter to that, but it's very hard. It's not really the right tool. And then finally, something that's prospective and not here yet really is digital currencies, where I think this is also going to be a challenge to central banks in a different way, perhaps, but it's also something challenging, and I'm going to come to that towards the end of my lecture. So I want to start out by talking about what happened in the United States and give an interpretation which maybe to some of you will sound apologist for the Federal Reserve. I certainly don't view myself as having any reason to be an apologist for the Federal Reserve. But as you may be familiar, maybe you're not, I should have put the cover up in my slides. The Economist magazine at the end of April had the cover, "The Fed That Failed." And that's been a very common theme in a lot of literature, that we had inflation reaching almost 9%, at least the headline inflation, but even core inflation's pushing up to 5.5%, which is something, again, people thought they would never see, and that this was just the Federal Reserve fell asleep. It should have been raising interest rates, but it wasn't. It was too busy with the environment and social justice and inequality and whatever. And in their policy, some of the policy framework they adopted in 2020 leaned in that direction. It said, as long as as long as we're not seeing inflation, we're going to keep heating up the economy. We're going to get every last person employed. We're never going to say that very tight employment markets are a threat to inflation. Our new framework will get away from that. I don't know if you saw this, but the Federal Reserve did a big review of its policies in 2019. I played a small part in that, though I'm not sure they listened to me, but they listened to a lot of people, and they came up with this new framework. And I think there's no question there'd been a lot of pressure in this direction. You hadn't had inflation in forever. The Federal Reserve had not raised interest rates to fight inflation since 1993. And you could find similar things around the world. Interest rates, real interest rates, inflation-adjusted interest rates just seem to be going down and down. I'll come back to that in a minute. And it seemed to make sense to run the economy hot. So that was something very deeply ingrained in how central banks all over the world were thinking about things. Disinflation is the problem. We do not have to worry about inflation. Well, as you know, the pandemic, there were massive stimulus. Now, the pandemic's not a normal recession. I won't go into detail, but obviously it's a very, very different thing when you have what is basically a natural disaster preventing anybody from going to work, creating all sorts of uncertainties and interlocking demand shifts. And it makes enormous sense for the government to come in very, very big. And I think to the credit of all advanced economies, they did, I think, a pretty good job in the pandemic. Well, I don't know if we did a pretty good job in mask policy and how to manage things. We closed schools forever in the United States. You did much better here in France, but there are many other countries that did like the United States. This was a catastrophe, and a catastrophe for inequality, I might add. But if you looked at the macro policy, it made a lot of sense. What's the point of having a strong balance sheet? You want to use it when you have a disaster. That was always been the history of how government debt is supposed to be managed. But when the Biden administration came in 2021, I want to emphasize, I sure as heck voted for him and supported, a lot of things he said he was going to do. And when the Biden administration came in, they were sort of breathing fire to solve a lot of problems, the environment, inequality, and other things. And there was a view that was growing somewhat out of what we call the progressives in the United States and the very bright people leading that, but also very much out of academics, that you could really run fiscal policy really hot. You could have a lot more debt. You could have much bigger deficits. And it just wasn't, you'd never pay higher taxes. You probably had Olivier present his paper here, which made an argument about that. I don't, to my knowledge, did not include a qualification about your debt can be higher, but don't spend it all at once, which I don't think the politicians got. And when, so in other words, an argument that says your deficit could be 1% higher than you thought it could be every year, and you should make use of that, is very different from an argument that you could make your deficit 15% higher every year, and it's not going to be a problem. And that's a difficult nuance to communicate to politicians, let me tell you. So there was certainly this argument to spend a lot, and they did. The Trump put in a giant stimulus even though he won't admit he lost the election, but kind of knew he was going to get kicked out anyway. He put in a big $900 billion stimulus in December 2020. And then Biden came in and put in more than twice that, and other things that did even more. And it's interesting how few people spoke up. My colleague Larry Summers was actually very courageous about speaking up and saying, this is going to cause inflation. And I think there's a whole cancel culture around anything which seems to oppose creating less inequality, and how could you say that if the purpose of this policy was to create, to try to improve the lives of so many people. And he wasn't against improving the lives. He had a better idea. He thought he had a better idea. Why don't you start with infrastructure? Why don't you start with things that contribute to having a more productive economy, and do this a little more slowly? And he was not listened to. I think, the rest is history, that the U.S. now has very, very high inflation. There are a number of factors, but I want to show it really is different. It really is different in the, oops, I did the wrong button. Wonderful. What did I do? Thank you. Yeah. This is from the last World Economic Outlook in April. and I'm just going to try not to spectacularly trip over that. But so this is in dark blue is how much of you have in black, where inflation is. It's gotten much higher since then, but dark blue is energy, red is food, and the gold is everything else. And you can see in Europe, energy is a huge percentage of what's going on. Food's a larger percentage, and a little bit of other stuff. And you could go around to other advanced economies. The US really looks different than everybody else. And that's suggestive of that there's a lot of aggregate demand in addition to the aggregate supply shocks. The aggregate supply shocks are significant. That's largely what's behind the blue and the red from the pandemic, from the war, Russia's invasion of Ukraine. So you can see the US is different. I am told, I don't have this data, but I am told that actually Europe's starting to have more of the gold. It's starting to increase. And you know, it certainly supports that something a little different was going on. So why didn't the Federal Reserve react? I argued that, first of all, it wasn't very easy when you hadn't had inflation in forever, didn't seem to have any problem. The progressives had swept into office. They wanted to try something out. Who are you, the Federal Reserve, to say, even though the American Economic Association doesn't really believe this anymore, I'll show you a slide a little bit later about that, even though there's, I mean, an extreme is modern monetary theory, but I think you could read Paul Krugman's New York Times columns and come to a pretty similar conclusion about policy, is suggesting this is fine. It's not going to cause inflation. Paul's on record many, many times as having said that. And remember what happened to Trichet when he dared to raise interest rates by, I think, 0.25% twice at the end of 2010, 2011, this going down as he should, you know, be sent to Siberia for having done this. I would say, had the Federal Reserve raised interest rates 0.25%, even said that they were thinking about raising interest rates, and anything had happened, the pandemic had gotten worse, any recession, they would own it, they would be blamed for everything. And why are you getting in the way when a lot of people, including on your staff, don't think there's going, you know, don't necessarily think this is going to be a problem? And you can get into, so I would say, you know, the foundations of this they're deep intellectual issues about what's going on. I had actually a wonderful visiting student from Stockholm, maybe 5 or 6 years ago, who was trying to work on inflation. And he came into my office frustrated and said, you know, he's just giving up. He doesn't understand it. If you told him that inflation's caused by the Federal Reserve doing a rain dance and that leads to inflation or not inflation, he couldn't improve on that theory. There was a lot that was not known. And so they, you know, it's sort of partly political economy pressures, partly uncertainty. And then, of course, if you follow the ins and outs of the Federal Reserve, it was, there was a period after that where inflation was still high, and President Biden hadn't yet reappointed the chair. In fact, he not only hadn't reappointed the chair, he had several slots where he's ultimately picked fairly left-leaning people. And there was, if Powell had raised interest rates, I think it's a pretty fair bet to say he would not have gotten reappointed. And markets would have interpreted that as meaning the Federal Reserve wasn't going to be raising interest rates so much. The notion of independence, is overblown in that respect. I've heard it argued from the White House that no, we were saying since July, we were telling the Federal Reserve to raise interest rates. Well, if you were doing that, how about reappointing Powell first and then telling him to raise interest rates if you're really sincere in that belief? I think the answer is they weren't. I'm actually just going to skip down. I'll come back to the others, to the AEA survey. This is from, actually, I gave the Mayacawa lecture a couple weeks ago, but at the same conference, Carl Walsh gave a presentation. I've taken 2 slides from his presentation, which are in turn taken from surveys in a paper by Guy Stevenson and Lapara Perez. And the American Economic Association has been taking surveys on a range of issues for the last 30 years on this consistent set of questions that has changed very little. So we have it in 2000, and I failed to put the labels here, but blue means you disagree, and gold means you agree, the orange is in the middle. And you can see on the question, the Fed should focus on inflation instead of real goals, which isn't specified, but used to mean unemployment and now means many things. You can see there was, pretty strong agreement that the Fed should focus on inflation. I have to say, those of you in the room that are students or professors are kind of well aware that most of the American Economic Association are not specialists in macroeconomics, but that's a pretty educated audience. And that's what they thought. Look at 2021. Now strongly disagree that the Fed should focus on inflation rather than real goals. This incredible shift. This is a huge shift. I'm not sure if central bankers are actually aware of this. Maybe you hear it that this is the academic world. And I would submit that if you read papers in the JPE, even the JPE, the QJE, the AER, whatever, the last few years, they reflect this. That's absolutely what the focus is. And here's one that's even more shocking to me, which is business cycles. Who should be in charge of stabilizing the economy? Fiscal policy or monetary policy? And again, this is the American Economic Association, 2000, I'm going to call it the neoliberal consensus, to be provocative. And then look at it in 2021, an incredible reversal. And so the Federal Reserve lives in this environment. The people they hire are coming in this environment. A lot of the people who are making comments are coming in this environment. So I think it's not to just say this is, now to what extent is it this political? Because there's, if you look at this other survey, there's been a huge move to the left across society, but absolutely across my university, every economics department. Again, those of you who visit Chicago will have a different experience, but maybe Minnesota, maybe Rochester, I'm not sure. But this is the general direction of traffic. So, certainly a lot of shifts there. I want to mention a couple other things that I think made the Federal Reserve's job difficult. So another question all central banks have had to face is monetary policy tight or is it loose? Inflation hadn't been high. Now the interest rate's low, so a lot of people say, well, monetary policy's loose. If you got the interest rate at 0, it's obviously loose. Well, if you look closely, it's not as obvious as it used to be. How much stimulus is in the system? In 1980, when I started at the Federal Reserve, 0 interest rate was like crazy. Or a 3% interest rate was crazy. You had a lot of stimulus in the system. But now, is that stimulus or is it tight? Because in fact, the shadow interest rate for a long time was probably substantially negative. No, I'm not saying the interest rate they could put in, but the zero bound created this problem on how low you could set interest rates. And there's definitely an argument to be made that despite QE, monetary policy had actually been quite tight for a long time. That's why you had such low inflation. And this is from a student of mine, Paul Schmelzing, who's actually a history student, who I was on his dissertation committee. I'm now actually working with him. And this is looking at the nominal interest rate. But if you looked at the real interest rate, which I haven't put up here, it's something quite similar. It's been trending down for 800 years. In fact, the real interest rate line's almost smoother than this. what Larry Summers calls secular, I don't know where it's going, but it dropped incredibly after the financial crisis. So Larry Summers talks about secular stagnation, which the meaning of which has morphed over time, but a central part of it has been that the real interest rate, the equilibrium global real interest rate is falling. And those of you that are not economists and, well, don't the central banks set the interest rate? They set what we call the nominal interest rate, but they don't, but if it's really too low, you get high inflation. So if you're trying to set an interest rate that leads to stable inflation, you actually have to feel that out. And yes, you can move it a little bit in the short run, maybe even a year or two, but you can't set it forever. If the market supply and demand for saving is screaming for a lower inflation-adjusted interest rate, you have to deliver it to them, or you're going to get deflation or inflation. And so during the financial crisis, the real interest rate fell 3% from peak to trough. It's even now, with interest rates going up, the 10-year is still down more than 2%. Paul Schmelzing's 700-year trend is about 1% every 50 years that the real interest rate's been dropping, but it's been very big recently. And this would be a bit of a tangent. It's something I'm working on. There's sort of a question of how much is temporary, how much is permanent. A lot of papers you see seem to take it for granted that the real interest rate drop is permanent. And I'll parenthetically say, if real interest rates rise, that will put a lot of pressure on the ECB and the euro. A lot of why there's been peace is that they've realized borrowing is free, so why should we worry about it? And if it ever isn't free, it'll be an issue. But this was also hard. You're the Federal Reserve, and some of the jargon they use is they were looking for the R star. I have a student, Catherine Holston, who's written a sort of a famous paper on this before I knew her, before she came to graduate school, about the declining R star with John Williams and Thomas Laubach. And nobody knows what it is. And so this idea, there were a lot of pressures on the central bank. So anyway, let me turn a little bit to longer term issues and talk about globalization and global disinflation. I've sort of summarized this already, but let me come back to it. So some people say, are we going to go back to the 1970s? We have inflation. Central bankers say, well, no, we know what to do. We perfectly well know what to do. We're going to bring down inflation. And I would argue that it won't be so easy. You had the wind at your back in the period of the huge Chinese boom. We're now in a period, maybe not such a boom in China, what I think would be an understatement, where due to I think many underlying forces, not just the pandemic, not just increasing centralization of the economy, China's been sort of set for a pretty significant slowdown in their trend growth for a long time. And I have a paper about this, if I get to it at the very end, about particularly the real estate and housing in China. And that may create different political economy pressures. It doesn't mean you can't have low inflation. Germany had pretty low inflation in the 70s. They cared a lot about inflation. I think it only got to 6% in Germany, 13% in the US, over 20% in Japan and the United Kingdom in the 1970s, if you can believe that. Germany, it didn't happen. Maybe Europe's like Germany now, and it won't. But maybe the United States is, maybe other countries. But I think it's an interesting question, what these longer run pressures might be. I think that one of the issues I don't have maybe enough time to talk about is if inflation goes up, that'll be one set of challenges that central banks have. But I think if the real interest rates end up staying very low, another challenge will be how do you restore the meaningful monetary policy in an environment where the real interest rate's very low, so if you, even negative perhaps, but very, very low, and if you want to have low inflation, it means there's very, very little room to cut interest rates. There are a number of policies proposed for this. I think QE is smoke and mirrors, which I've said. And I think if it wasn't, Japan would have 20% inflation instead of 0. They've done helicopter money. They've bought the stock. The Bank of Japan's bought the stock market. They've done every conceivable thing except I say, couple policies that economists have most promoted. So one idea you see is raising the inflation target. That was actually first proposed by a couple of Federal Reserve economists in the 1990s, Führer and Madigan, and it was sort of most famously followed on by Paul Krugman in a seminal paper he wrote for Brookings in 1998, where he argued the solution when you have the zero bound is to raise the inflation target. He was going to raise it for 15 years, but that's a very long time. And many, many other people, Blanchard in 2010 and many others have taken up this idea. If you read the Federal Reserve Review in 2019, this idea was promoted, I mean, not by the Federal Reserve, but by the paper they chose to summarize all the papers, said that maybe we should raise the inflation target. I don't think this is a terrible idea, but I think it's oversold. I think there's some problems with it. The most obvious problem is the public is only dimly aware of what the central banks are doing. There's Yuri Gordachenko at Berkeley has done a series of beautiful papers on this showing businesses, consumers, they have no idea what the central bank's saying. They just don't have a clue. Like their surveys, maybe we're just Americans and we just aren't informed about anything, but it's really kind of amazing. A long time ago, former colleague of mine, Kathy Mann, who later was chief economist at the OECD, she had a way of describing it that when central banks talk to markets, it's like talking to your dog, that, you know, they kind of hear the voice that you're using, but not really a lot of the specifics. So I think it's going to be very tricky. And there's some other issues that if you raise the inflation target, in principle, either you'll have more distortions. Mike Woodford's argued that, because if you have asynchronized wage and price setting, then there's more buildup of differences over time. Or, he doesn't argue this, but I do in my book, the alternative is that people adjust more frequently, not necessarily right away, but after a while, and then monetary policy is less effective. And any model you want to write down, when the adjustment is more frequent, when asynchronous adjustment is more frequent, monetary policy is less effective. You would need a bigger interest rate cut in order to get the same effect. So you've raised the inflation rate. You may have a target inflation rate. It might work, but it might prove to be very temporary, the effect that you got. A topic I've written about for a very long time is the idea of using negative interest rates. Not like you did in Europe. The only way to effectively use negative interest rates is to deal with large-scale cash hoarding. I don't have time that I really demand to extensively speak about this, but let me just say the issue is not dealing with ordinary people. You can exclude 99%, maybe more than that, of people in businesses from the effects of negative interest rates. You can allow small cash transactions. You have to prevent people from hoarding 10 billion euro at a time in order for negative interest rates to be truly effective. They did not do that anywhere, not in Japan, not in Europe. It was a third rail, and I think that was I think over the long run, if we're in this situation, it is by far the most elegant solution. And there are a number of ways to do it. One way is to reduce, sort of change regulations on the use of cash that don't make it difficult to use for a 500 euro transaction, but make it very difficult to use to buy a house or buy an apartment. And I argue that in my book. There's another way that I also show in my book, which is basically to create, and this sounds a little head spinning, an exchange rate between paper currency and electronic currency that depreciates over time. Very, very simple to implement. It's an idea from the 1930s. I actually trace it back to Kublai Khan did this, and the Mongol treasury had a variation of this. And I think this is what everyone's going to eventually do if we continue to have these very low real interest rates. I disagreed with the Fed that they didn't at least say we should look at this issue back in 2019. Now, why might this have mattered recently? Well, part of the reason the Federal Reserve was reluctant to raise interest rates is they thought that if inflation goes up, we know how to deal with it. We'll see. But if inflation goes down, we don't know what to do, because even though we say QE works great and our alternative instruments are great, nobody seriously believes that. And therefore, we're going to take the risk of inflation going up. It's an asymmetric risk. Well, if you could do effective negative interest rates, it wouldn't be. You could temporarily bring interest rates down. That would actually raise long-term interest rates, create inflation. It wouldn't have been a problem. So I think this is actually one fundamental way that central banking needs to be changed if we continue to live in this negative real interest rate world. I'm sorry, falling real interest rate world. And even though I think that the drop after the financial crisis probably has a temporary component, I believe Paul Schmelzing's work that the long run trend's rather impressive. And probably, if not in 5 years, 10 years, at some point, we'll be back in this situation where this needs to be done. So let me just conclude with saying something about digital currencies and crypto, which again is a problem facing central banks, and clearly, particularly in emerging markets and a number of potentially some smaller advanced countries, particularly a big challenge to independence, that you have these parallel currencies. It's almost a form of dollarization. So in my book, I argued that you can't allow this. I don't think it's an equilibrium for a lot of reasons to allow private digital currencies to push out the government currencies. And one of the most basic reasons is, to the extent they're pseudonymous, things like Bitcoin, it's very hard to collect taxes, control illicit activity. That has not been a huge problem in the advanced economies yet, but it's a massive problem in emerging markets. And I have an NBR paper on this you can look at with Carmen Reinhardt and a young co-author at the World Bank, and I have a more technical paper on this. But it's a big problem in emerging markets. The IMF is starting to recognize this, and eventually it's going to be a big problem in other countries, in the advanced economies. And I'm not sure that there's really a solution to this that doesn't involve fairly strict banning of cryptocurrencies in use in any legal transactions. What I talked about that in my book. I have to say what I got wrong was I looked at the history of innovation. It always comes from the private sector. You can go back to standardized coinage in 7th century BC. You can go to paper currency under China and then later in Sweden and other countries in Europe. You can look at other innovations in banking. Always, apologies to my hosts, but always it's coming from the private sector. But the public sector eventually regulates, often appropriates. And I said the same thing is going to happen here. What I said I got wrong is I didn't think enough about, yes, that's true, but it often takes a century for this to happen. It doesn't happen overnight. I suspect it's going to take a while. In my country, there's no big movement to regulating cryptocurrencies in a serious way. Colorado and Florida want to be El Salvador, and the crypto world are big contributors to politics. You wouldn't have watched our Super Bowl. You wouldn't even be aware of it, what we call football, but it's the biggest TV event of the year. Crypto had 20% of the advertising in that. A lot of the major sports stadiums are being renamed for various crypto groups that have bought them, and they've become very influential. It may take time. I think I should wrap up. I don't have so much time to talk about central bank digital currencies, except to say it's very secondary to regulating the private digital currencies. The central bank digital currencies are coming. I talk about it in my book. Yes, they're coming, but it's not so obvious what the use case is for them that's so urgent. I actually think part of the reason central banks are talking about them is they don't know what to say about cryptocurrencies, and so they say, well, you can have ours, it's better. Yes, we'll know everything you do and see every transactions you make, subject, maybe to some small ones, but you'll love it. And I'm not sure that it's really on the same page of what the topic is. So, let me just conclude by just again mentioning my late colleague Alberto Alesina, who worked on political economy, and there are again some very prominent young scholars working on this, but it's been a dead topic in macro for a surprisingly long time. The idea that fiscal policy involves political economy, it just isn't there. Actually, I wanted one other thing, if I have time, a technical issue, an example of this. There were a rash of papers after the 2010 financial crisis showing that if you're at the zero bound, the optimal thing to do was make fiscal policy go very hard until you lift it off from zero. You can actually see this in Krugman's 1998 paper where I was a discussant. So there's a very nice paper by Cristiano, Eichenbaum, and Rebello in the JP 2011, which states this in a new Keynesian model very nicely. They show that if you don't take your foot off the gas, it can be very bad. But that's okay. You take your foot off the gas when you go from zero. And I think, of course, there's no political economy in it. It's not easy to take your foot off the gas. It's not easy. First of all, they have fiscal policy dripping out a little bit at a time. And then, as soon as it hits zero, you take it off. You're committed to that. But in the real world, and that's particularly true in my country, you pass fiscal policy in these big chunks that last for a year or two. And often, you're not getting the timing of when it's coming off the zero bound. You're not going to be able to get that exactly right. Our fiscal policy was too much, too late. It was well-intentioned. It was fitting the Krugman model, but that's not taking into account the political economy. Monetary policy also has its limitations, but it's much less. And so again, I want to tie it into this is really about the research, the intellectual foundations of countercyclical policy. What is the role of monetary policy? What is the role of fiscal policy? And there's been this consensus that I think confuses the necessary redistribution of income, which I fully support, with let's use fiscal policy instead of monetary policy to opportunistically raise the size of the government. And it's confusing different issues. I think we need an independent central bank. We need the central bank to have tools. We need the central bank not to be driven out of business by private digital currencies. And I hope this latest test, however it turns out, will create some new thinking on this topic. Anyway, thank you very much.
When you try to understand why is it that the central banks of the world in the US, but also the ECB to a certain extent, got sleepy, I guess one of the reasons is when you look at long-run inflation expectation, such as revealed by the markets, you find that inflation, even today, remains pretty well anchored. So to the large extent that this is something that is closely monitored by the central bank, in fact, they're always looking at that, I wonder the extent to which they got sleepy was not related to the fact that in our models, Barrow Gordon, your own model and so on, there's really what matters is wage expectation much more than market expectation. So question is whether the market itself as, again, embedded in these forward rates, got it wrong so far as the underlying inflation was. So that's my first question. You want to get on it?
Yeah, I mean, that's a very good question. And I don't have a glib answer to it. But I think you'd find historically markets are not very good at turning points. I'm just going to put in two slides I didn't get to. One is the huge potential change in fiscal needs that are coming, not just from Social Security, but what happened in the Ukraine, potentially is going to happen in Taiwan. This is the peace dividend in the United States. This is from a paper by Pierre Yared, who I mentioned earlier. Defense spending as a share of GDP in the United States was over 11% at the end of the 1960s. It was still well over 6% when the Berlin Wall fell, when the first Cold War ended. It's half of that now. If you just went back to the 1980s level, that would pay for all federal expenditures. It is a massive amount of money. If I were to draw the curve in Europe, it's embarrassingly flatter at a very low level. Good luck with that. In the future, I suspect, I'm not saying what's going to happen right away, but I suspect you're going to find tremendous pressures from the outside world, the realization that you don't want when we get a crazy president in the United States to be totally dependent on what happens. These are going to create a lot of fiscal pressures. And the second point, which I didn't get to talk about so much, is the fragility going on in China that's changing the equation. China, this is from a paper of mine of how much China spends on how big real estate is, direct and indirect, in the economy in China. It's on the order of 23-24% of GDP, and even larger in terms of if you include import expenditures. It's way higher than any Western countries except Ireland and Spain at the height of their housing booms. And this is an economy that's very fragile. And you can look at infrastructure. It's the same story. They're very good at it, but you reach decreased diminishing returns, even in this. And so throw in COVID, the COVID zero policy, which is a political crisis in China, throw in the incredible movement towards centralization, you are looking at a very, very different world ahead. So yes, I would argue particularly the market's missing what's going on in China, and you're probably also looking that, yeah, the Germans raised their, defense spending a little bit, but it's not going to stop there. And I think between the expenditures and between the supply side shocks coming from China, I see a very different world over the next decade.
Right. No, exactly. But that's a sort of point. That is, in your presentation, sort of say the central bank got distracted towards other business, which I understand and agree. But the point also is relying too much on market expectations, which are most often wrong. And it's a different kind of, one is, I would say, a critique of raising up the box of what the central bank can do, and the other one is a different kind of critique. That is, it's too reliant on the market for its own business.
I mean, obviously, I'm saying what I think. I'm not saying this to be provocative.
Yeah.
I will acknowledge that, as an academic, if you say, oh, the market has it about right, central bank has it about right, let's go home, that's not very interesting. My intellectual grandfather is Robert Mundell, the late Robert Mundell, who was Rudy Dornbusch's advisor, was my advisor. And Mundell, he denies this, but Rudy told me many times that, Mundell used to be in favor of flexible rates, but then when they had flexible rates, he became in favor of fixed rates. When Europe did fixed rates, he became in favor of gold. And Rudy said, what's going on? What is it? And he said, you have to be against whatever they're doing.
Right, we understand that. Okay, so I'll pause on my second question, really. Let's go. Yeah, please.
So thank you, Professor Rogoff. I think that was an absolutely amazing lecture and very wide-ranging. But I guess when I came in, I was expecting something different. Okay, so not totally different, but a little bit different. Which is, for me, some of the issues that I might find salient about that might change central bank independence might be around fiscal dominance. Historically, I think a reason why central banks weren't independent was because of relationships with debt management. Now, maybe that's less salient when interest rates are very low, but debt is very high, and as we've just discussed, the big fiscal pressures. The other one is the role of financial markets and of leverage. Finance is hugely more important. There's obviously a whole set of issues around that, particularly now, but also historically, when recent years the Greenspan put and all that kind of thing. Now, I think these raise many of the same issues as you raised. One is the economic impact of these factors. Secondly, there are things that I think as academics, literature, we don't understand some of these things particularly well. And then there's a political economy dimension. So I wondered if you could just comment about how those two factors fit into your framework.
Those are great comments. Can you introduce yourself also?
Okay, so I'm Sebastian Barnes from the OECD, but currently at the Banque de France as well.
Those are great points. I should have added them in. There, when I worked at the Federal Reserve, Paul Volcker was there. The stock market was 1,000, and now, even though it's falling, I'm talking about the Dow Jones, I don't even know what it is now, but 30,000+. You'll see, I don't know what it is. I'm proud of that. And debt was nothing. Debt had been wiped out. Those issues weren't there. So on top of the other issues, it takes a very brave central banker to raise interest rates when it feeds very quickly into debt, which is acutely true in the United States, which has a remarkably short duration. It's under 4 years of debt. It's longer in many European countries. And you're also right, the financial market fragilities were not the same. That raising interest rates today, when there's inflation, it's way harder. So there's been a period where, in addition, I talked about sort of the really long arc of globalization, but you're absolutely right. There are other factors which make it much harder. Now, they're hoping they don't have to raise interest rates very much. But a thing I would say, my prediction of what's going to happen, I'd say, especially in the United States, but to a lesser extent in Europe for sure, but I think it's going to happen in many countries, is they will raise interest rates, the recession will start kicking in, and the polls which currently show everyone cares about inflation will quickly shift to caring a lot about a recession. I think they will stop short. I think we'll still have inflation well over 3%, maybe even 4% at the end of 2023, not just 2022. Because of these pressures, they're going to start raising rates, and things are going to start cracking. So it's a very difficult situation that central banks face at the moment, that they have not had to. They have not faced this in a very, very long time. And maybe everything's transitory, maybe the Chinese are amazing, and maybe just once again they will defy expectations. and grow at 10% when everyone thought it would be minus 2%. The World Bank came out yesterday, just a couple days ago, sharply marking down their China growth expectations. Who knows? Maybe the war in Europe, instead of getting worse, will reach a calm much quicker than we think. Maybe the Federal Reserve will just do a great job in achieving a soft landing. But it's much harder than I think. What Paul Volcker did, I was there, it was incredibly difficult what he did, the pushback. And I think it would be harder today.
A very quick point on just picking up on what you say and on the issue of globalization, because you're very bold on that, and that doesn't seem to be sort of the main view in general. People say, well, globalization did put some pressure on prices, but was not the main reason why low inflation and so on.
Oh no, this is coming. It's not happened yet. That's I'm looking at the arc.
No, exactly. My question goes, if you can, you're talking about the past, but the issue now is we are facing these uncertainties of what is going to happen. We don't know. It's friendshoring or globalization, different types. So if you can expand a bit on the mechanisms you think about openness, and then how would that will, yes.
So we talked about this a little bit, but there are two factors that have been very big in the world, and there's a debate about which is the bigger one. Is it globalization? Is it technology? Is it the interaction? Is it both? It's interestingly, the international economists for a long time said, well, it's mostly technology, and the labor economists said, no, it's mostly globalization. And you can look at the Otter papers on the labor side, and Feenstra and others on the other side. But I think that I think globalization's been at least half of it, and that whether it made the market bigger, whether it increased competition, it reduced monopoly power. In the models we have, if you increase competition, you make prices more flexible. If you decrease monopoly, you decrease the gains from trying to have monetary policy more aggressive. You change the Phillips curve. So in the little baby model that I had in 2003, and Marina Hollick and Pierre Yaret had their restud papers 1,000 times better. But in those models, those are the factors that matter. It's not that China's producing cheaper goods. It's the fact that they're changing the monopoly power of particularly workers, really, and changing your pricing power is the thing really ultimately long run driving inflation. And I think that's made it much easier for central banks, and we'll see. All the central banks are talking tough. We're going to get inflation down. You don't have a thing to worry about. I think you have plenty to worry about. That it's much more difficult dealing with the war, dealing with a very political COVID-19 lockdown in China. These are phenomenal shocks. There may be more coming, and we'll see.
So when you talk about political economy, you think also about market power.
Well, that's one thing that appears a lot in the models. There are clearly other factors that potentially go on.
Thank you. So I have two related questions.
Introduce yourself?
Yes, please. Sorry, I'm Eric Monet. I'm a professor here.
Mm-hmm.
I have two related questions.
Oh my God! Wow. I'm honored to get your question. And yes, I
so now you know I'm under 40. I have two related questions on central bank independence. So first, when you describe what happened since the great financial crisis, and you're clearly dissatisfied with a lot of the measures taken by central banks, but all this was not imposed from outside. I mean, it was actually guaranteed by central bank independence. I mean, this was especially true in Europe, where actually many of the things that the ECB did, I mean, in 2010, I mean, most of the government in Europe would have disagreed with that. So it's really central bank independence that moved that way, and in Europe really moved European integration. So it's a paradox that still needs to be considered and maybe to explain. How do you account from that in your story? And my second question, which is clearly related, is what is your position at the end? Do you think that we need really to come back to the setting institutional framework, policy framework of the 1990s, or do we need a redefinition of central bank independence? What is your 2.0?
Yeah, on the first question, I mean, yes, central bank independence has worked really well. I'm very in favor of central bank independence. I think this period's chipped away at it. When the ECB acted, it was in a fiscal capacity, not a monetary capacity, that it was doing its quantitative easing. And I'll tell you, in the United States, as they've realized this, it's having, in a lot of countries, it's having effects. But again, in the United States and most countries besides Europe, quantitative easing is very different. It's not an independent policy. For example, in the United States, what were they doing quantitative easing at 90 billion a month? The Federal Reserve, the Treasury turns over $5 trillion a year. It can put 1 week debt if it wanted. 1 week debt and reserves are perfect substitutes. The quantitative easing in Europe was done in the name of fighting disinflation. As has been revealed in the last week, that was never really what it was about. And it made sense. I agreed with it, but it was protecting the South from collapse. And Europe is a much more protected independence, and the Maastricht treaties are really different than a lot of other countries have. So, and I don't know how Europe will hold up relative to how Germany did in the 70s, but it's in a institutionally stronger position than most central banks. On your second question, there's sort of 2 points. I do think if we have continued decline in real interest rates, you have to think about either raising the inflation target or my preferred policy of what I call effective negative interest rates. And then you can restore the instrument that central banks use. And if you can restore their instrument, that would help protect their independence, because otherwise they're sitting on their hands. And then when inflation happens, they're slower to react. They have less independence. The second issue, which I'm vaguer about, but I do think it's extreme. It's the digital currencies is going to creep up very fast, and central banks and governments, it's not something central banks can do alone, need to be much more alert to, I wouldn't say living with cryptocurrencies, I'd say banning cryptocurrencies than they have been. And those are both very important issues to address. Central bank digital currency, less important, an idea, but less important. So yes, I didn't frame that very well, and thank you for asking that, and congratulations.
Very collectively proud of it. So, who else?
Oui. Louis-Marie Polan, I'm a central bank economist at Banque de France, and I used to work at ECB also. My question will be at least maybe orthogonal to your points, because when you say that when the central bank has acted recently as a fiscal policymaker, we could even say in some cases that central banks have worked as structural policymakers. If you look at the most efficient policies implemented by central bank in Europe, in terms of jobs saved and investment, real investment, etc., we are looking at policies actually that focus on financing firms. Credit mediation in France and collateral policy all over Europe has been focused to efficient firms, that is preserving credit to efficient firms. It's basically Diamond Dubvig 83 stuff. That is you basically put credit, you save credit to efficient firms. So if you do that, we have the point that central bank is basically increasing growth and just avoiding inflation just by that. But this is not usual monetary policy. This is structural policy. So my point is, how can you defend the independence of central bank in such a framework? Because the arguments are basically the central bank must be neutral and must be, but it is not the usual argument for central bank independence. So that's my main question. And also, if we look at what has happened over recent years, it was not a surprise to people who have worked on inflation, at least in Banque de France and the ECB. I mean, at least to a few people. I've started my career doing inflation forecast, and we were doing a very great job just by using cost-push model. So when we observe in real life with big shocks that supply shock have a strong effect on inflation, this is no surprise for us. Conversely, when we see that there was a big balance sheet increase in central bank, in the balance sheet of central bank with no effect on inflation, this was half a surprise because we found before, 20 years ago, we found an effect of monetary base on inflation. But I was working with the best people, Upil, for instance, who is now the chief economist of ECB, and with all the German guys who were the expert on that. And this was something we observed in data, but nobody was able to explain why. So this is my second question, which is very basic, very academic. Do we know how central bank can really affect inflation, apart, of course, of structural policy? Thank you.
So let me work backwards from the QE question back to the financial frictions question. So I think we do understand. First of all, it is different in Europe because there's this, the ECB is the only truly, fully functioning European institution. And it takes on responsibilities that are much greater than a central bank. It is much more than a central bank. And it's made use of its effective fiscal power, which is not nearly as strong as a true fiscal authority, but it was very important. But I think we very well understand why quantitative easing doesn't do much. And think about the United States, which is simpler. So what quantitative easing is, and I say this, that if you don't know what it is, you've chosen not to know what it is because it's written about so much, and those of you that know, but let me repeat it anyway. Quantitative easing is essentially the Federal Reserve issues bank reserves, money, and buys up long-term government debt. But I mentioned why you really want to look at the consolidated balance sheet of the Federal Reserve and the Treasury, because the Treasury 100% owns the Federal Reserve. These reserves are actually indirectly obligations of the Treasury. And the only difference between bank reserves and Treasury, short-term, say 1-week Treasury bills, is who can hold them. So Treasury bills can be held by anyone, well, maybe not Russians anymore, I don't know. They can be held, well, they can hold them, we just won't pay them. You can hold Treasury bills, but you can't hold bank reserves. But the interest rates are totally arbitraged. Actually, bank reserves pay a little higher than Treasury bills. They're totally arbitraged because banks hold massive quantities of both. And so, you're not even getting to a corner where there might be some friction that's mattering. You're almost certainly the only effect is somehow communicating something about monetary policy. It is just, smoke and mirrors. And again, the Treasury, if it wanted shorter term debt, it could just issue shorter term debt. It's a vastly bigger player than the Federal Reserve. If you're looking at what you're calling structural policies, where you're buying private debt, that's actually also something Treasuries do all the time. Not in the sort of day-to-day operations, but they issue guarantees. In many countries, the effect of Treasury intervention into markets is very large, and I have people like Daniel here who knows infinitely more about the French banking history, but my impression is that was kind of like a big thing in France. If we go back 40 or 50 years, the intervention into financial markets was just very, very large. And so, yes, the ECB is filling, missing markets. You might also fill them by improving your capital markets. But part of my impression is that in the first few years after the crisis, part of the problem in Europe was the banks were moribund, they were very weak and unable to lend because their balance sheets hadn't been cleaned up. Europe was very, very dependent on its banking system, and the ECB stepped in a way trying to deal with this. But yeah, no, that was certainly sensible. Am I wrong that the take-up was never very enthusiastic on those policies? I mean, they were positive, but not particularly decisive. I may have that wrong. I may be out of date, but they made sense.
Okay, we
Yeah.
close. Thank you.